right. Good morning and good afternoon, everyone. My name is Sandrine Zoku. Thank you so much for your patience. I'm the Director of Invest Africa US. We are an organization that looks to connect US-based investors to a network of fellow investors, business leaders, and entrepreneurs, all who are working towards developing the continent. So we're really excited today to be having a conversation all about East Africa, all about Kenya, the economic recovery, some investment opportunities, and some innovations that are taking place in the country. So I will pass it over to our board member, Aubrey Hruby, as well as the founder and CEO of Insider to kick us off. But a couple of things, just some house rules for you. If you would like to introduce yourselves or if you have any comments, please feel free to include that in the chat. If you have any questions, we have a Q&A function within Zoom where you can pose a question. And from there, Aubrey will be weaving in the questions as the discussion progresses, but we will most certainly be dedicating some time at the end of the conversation for solely for questions. So Aubrey, I will pass it over to you.
Thank you, Sandrine, and thanks everyone for joining this morning or afternoon, depending on where you're sitting and where you're COVIDing. It's a real pleasure to have this conversation today about Kenya and economic recovery in East Africa. And I'm so pleased to be joined today by Edwin Dande, the founder of Cytonn Investments, and Guillaume Arditti, the founder of Belvedere Africa Partners. And so Edwin's joining us from Nairobi and Guillaume for Paris. So we're really going to have an international discussion. We know that Kenya is not unique in that it has been hit by the economic consequences of COVID. I think the caseload is something slightly under 5,000, so less than where I am sitting in Washington, D.C., but the economic consequences have been quite dire, with economic growth reduced to about 1.5% this year, down from pretty regular and strong growth of upward of 6% over the last couple years. And so this has resulted in job losses, similar to countries all over the world, and therefore has really stimulated the need for a recovery effort. And there's this new economic recovery plan that is unfolding on a day-to-day basis in Nairobi that involves everything from a new credit guarantee scheme to youth employment programs and really efforts to have a national stimulus. And so really today we wanted to talk about what those efforts look like from the investment community and where there are investment opportunities during this time or moving forward into Q3 or Q4. So it's with that stage set that I want to turn to Edwin to hear a little bit about Cytonn Investments and what the view is from where you're sitting. So thank you for joining from Nairobi today.
Thanks a lot, Aubrey, and hi everyone. I hope first of all we are keeping safe, and most importantly, having the faith that this will be behind us and we will go back to some sort of world. I hear everybody saying it's no longer going to be the old normal, but wherever we shall get to, we have to keep very optimistic so that once this is behind us, we go back to our lives. Now, going back to the topic at hand, first of all, Cytonn is an alternative investment manager, primarily investing in residential housing, but about a year ago, we acquired a fund manager, and now we have regulated funds, primarily money market fund. Going to the topic at hand, of course, it's tough times for everyone all over the world. It's tough for us here in Kenya. It's tough for us here in Nairobi. But of course, tough times don't last. Tough people will last. So of course, tourism has taken a very serious hit. I mean, it's almost like it turned overnight from being able to host tourists and being able to host hospitality events. Those are now illegal things to do. You cannot have an event. So obviously, restaurants, travel business, all of that shut, and tourism is one of the highest earners in terms of forex exchange in this country. So a lot of unemployment. Agriculture is one of the largest economies, sections of the economy in terms of GDP. And the moment tourism shuts down, there's nowhere to sell eggs, there's nowhere to sell agricultural produce, so prices have completely taken a beating. So pretty much all over the economy, things are gloomy, except maybe in the fintech, the tech area, the data area. So technology seems to be a safe place to be. So then the government stimulus, which is primarily focused on helping the most vulnerable, helping with youth unemployment, putting some money into the hospitality sector helps a little bit, but I think we'll have to do, we should do things that are more dramatic. When I look around the world, I think the person who has been very, what I would call bold, I think it's the US economy, where they have gone to even buy private debt from the hands of companies, because the best thing to do is to keep as many businesses afloat, as many people employed, so that when things turn around, you can then, you are not starting from digging deep, keep as many people as possible employed.
Yeah, and on that, Edwin, I mean, the stimulus program that Kenya has released is about 2% of GDP. Some people think it needs to be 4%. The issue really is fiscal space. Where can the money come from? We know that the IMF has stepped up with about $740 million in emergency financing for Kenya. And you know, that's probably not enough as well. So given the fiscal space constraints with borrowing additional money on Eurobond markets or from other bilateral donors, it's hard to see where the sufficient stimulus can come from.
Yeah, definitely. There's a report that was done. I can't remember the research house saying 2% is not enough. Let's go to 4%. I also hear what
EY
Aubrey
did that last week.
Yeah, EY. And then I hear you, Aubrey, are saying the fiscal space. You've already borrowed too much. You don't have much room. However, I would look at it as a one-time expensive insurance that we have to purchase, because if you don't do it, you will end up with, you already have a lot of unemployment. You'll end up with a structurally destroyed economy that you'll have to rebuild anyway. So I wouldn't know for sure where the money would come from, but I would say if you can borrow, do borrow and do be bold about it. And even the 2% that you are doing, I'm not sure that we are deploying it in the right, because yes, it's good to keep youth employed, but sweeping the streets, cleaning trenches, yeah, it's good to do, but I think we need to do things that are more sustainable. So the 2% needs to be redirected to structural places, things that will keep employment, that will sustain employment even after COVID. And then I would find a way to borrow more, because it's a one-off insurance to make sure post-COVID, you still have a functioning economy.
Yeah, and on that, I mean, we know Kenya still has plans to issue a green bond. So maybe there are some opportunities in niche areas to continue to raise money. We know there's a lot of interest in Europe, for example, in climate financing. And so maybe Kenya will take advantage of that opportunity. But I want to come back to one area that the stimulus is being applied to, which is the credit guarantee scheme. I had some calls yesterday with a couple Kenyan businesses and businesses operating in Kenya that says credit has completely dried up in the market, that it's almost impossible to get working capital, et cetera. So this credit guarantee scheme, which is about $3 billion, or 3 billion shillings, sorry, was announced last week. But I'm not very clear. It's supposed to be for SMEs. I'm not very clear on how it's trickling through. Do you have a sense on the credit situation locally?
Credit is very hard to come by, and for obvious reasons. It's an SME economy, and SMEs have been extremely hit. So if banks had lent to SMEs, the first thing they're going to be doing is to be looking at their own capital structure. You saw Equity Bank had declared a dividend, even picked the date of payment, and then came back and say, now that we've understood COVID, because it took a while for people to understand COVID, now that we've understood COVID, we will not even proceed with the dividend payment, because why should we pay you? Then we come back again looking for the same capital. So I think banks are going to be internally focused for a while, trying to understand what does this mean for our capitalization ratios, and even understanding who do we then lend to. So credit is going to be frozen for a little while. Some places like our own sector, real estate, I mean, credit is as good as gone. So any credit facility that the government can bring in, and I think that's where they can make a huge difference, will go a long way. However, 3 billion shillings is almost like a non-starter. I mean, one farm.
A non-starter, it's very small, yes.
Yeah, so for practical purposes, I would say we really don't have those credit facilities, but that's where I think the conversation ought to go to be able to sustain businesses.
Sure, and I want to bring Guillaume in that conversation because he's looked deeply at credit markets and opportunities to bring debt from outside the country. And really, I mean, the central bank on this credit guarantee scheme, I think, expects to leverage other players like the World Bank, IFC, AFDB, EIB, and others to bring in other resources. The question is, will the private sector kind of step up and investment funds come into the space to fill that credit gap? Guillaume, will you tell us a little bit about your work and your thoughts on that?
Yeah, sure. I mean, we've been focusing on the potential private debt can bring to Africa for quite a while. Just as a quick background, Belvedere Africa Partners was founded as an advisory boutique in the beginning, focusing on financial structuring and strategic advice on projects in Africa. And then having analyzed a bit deeper the financing gap, we saw an opportunity to work deeper on the private debt market. So just maybe to give you a very general figure, at the moment the private debt market globally is about $650 billion. It's mainly a market which is working in the US and in Europe, and there is close to nothing in Africa. Our take is that at the moment there is very good opportunity to match the requirements of financing requirements of projects in Africa, as well as a number of investors' requirements internationally. And this is because there's been some trends that has been initiated I would say 3 or 4 years ago, that we're seeing the results now. I mean, we can go back to this a bit later if you wish. So what we're seeing is that there is definitely an appetite which is growing from investors to move out of their usual borders and to try to work on the continent. So I think we're progressively moving out, hopefully, from this kind of situation in which we've been stuck for a number of years, where on one side you have people who've been working in Africa for a very long time. On the other side, you have people who don't know nothing about it, and basically, until very recently, we didn't have any gray zone. That has been changing before COVID. There's a number of people in Europe, investors, who are looking now at the continent and with a curious look, just as someone who discovers a new market without the same.
And what type of investors? I mean, you know, here in the US, we've struggled over time. We've talked about for maybe 5-10 years that, oh, American pension funds are going to get involved in Africa, are going to get involved. And it's been a slow process. And this question of search for yield, you know, everyone's willing to take negative yield, but, you know, will they go and find the risks? And so it's one of those things where we haven't held our breath. We're seeing slow progress on pension funds. But do you see another type of investor that could be tapped into?
Yeah, I think the more institutionalized you get, the slower the move is, for obvious reasons, because well, the culture of being very conservative to safeguard the savings of their stakeholders. So I would say regarding pension funds or very institutional investors, the trend is a bit the same, but we're seeing an evolution progressively, which I would say is starting from investment funds like large houses. You can also feel that move within a number of asset managers, which are linked to, for instance, wealth management and investment banks, and then also maybe for, I would say, a bit more following insurance companies. And so I think yes, the move is going to be progressively made with those steps. And eventually institutional investors like pension funds will follow suit as well.
And Edwin, how do you think about that from a fundraising environment? Do you see additional funds coming into Kenya through institutional investors? We know that there's been some talk in Kenya of kind of a consortium of local institutional investors working together to drive infrastructure investments in particular. Give us a sense of kind of where you think partnerships could be developed.
Yeah, I think in terms of funds coming into Kenya, East Africa, for now, we'll continue to see the guys who are already familiar. As he said, institutional guys take time. So there are guys who've been in this market, the ECPs of the world, CDC, Actis, Fund, the DFIs. They're already familiar with the ground. They have people on the ground. Ourselves, our initial backers were Finnish. So those guys will continue to be in the market. They already have money and assets in the market. But I feel that at this particular point, all over the world, everybody is kind of inside looking and saying, how do I go through this environment? Except for those, I've seen a couple of people talk about putting together a distressed fund, go look at assets, but they tend to be people who are already familiar with the market anyway. So they are saying, now I see an opportunity for debt financing, for distressed assets or for distressed companies. So I think in the short term, I don't expect any new names. It's the names that are already on the ground that are going to come in. On the issue of pension funds, it's an extremely slow process to get local pension funds into private equity, and the outside pension funds will want to see the local guys jump in first. That process is going, it's easier just to go and raise money from a DFI if you're looking for private equity money.
Yeah, I mean, the DFIs are there as kind of, you know, it's, you could either say it as first resort or last resort, right? And they've been there for 20 years plus, in CDC for 40, 50. But the question is, are they kind of catalyzing new investment? Because I was just seeing that IFC and DFC, the US DFI, had just invested in African Invest Fund 4. So, you know, if they were there to stimulate new investment, that wouldn't necessarily be the case. And I like the African Invest guys, but, you know, the question is, what is the role of the DFI, if not to kind of stimulate this first-time fund managers or bring new investment into the region? So agreed. I mean, IFC has an office in Kenya and some of the others, so they're close to the market. Whether or not they can bring in new investment from the private sector or de-risk it is a question. And one area, and then again, the pension funds, I agree, local and otherwise have been slow. In Kenya, how have you seen the local pension funds look at alternative investments in terms of investing in private equity or debt funds, both within Kenya and outside of Kenya, Edwin?
Yeah. It's still an asset class that people are tiptoeing into in terms of local investors. They are still more comfortable. We are still more comfortable with government securities, corporate paper. The farthest people would probably go is private commercial paper, and of course then listed equities. And the real estate is another place that people are familiar with because they can see it, they can touch it. Putting money, yeah, it's tangible. Putting money into a fund managed by a GP is something that is still new. But to be honest, we also don't help ourselves. I mean, recently I saw some very interesting regulation proposed that private equity funds and venture capital funds now have to be regulated. And I looked at it and wondered, who does that? I mean, that's a way to keep constraining capital. GPs are not going to want to be regulated by a regulator. It's a relationship between the LPs and the GPs. So we also don't do ourselves a lot of service, and there's a lot of work to be done on the policy and the regulatory space to be able to show that the more flexible the policy environment is, it helps with the likelihood of bringing in capital, and the more stringent it is, it will make capital shy away.
So is it a policy regulatory issue? Because, for example, in Nigeria, Nigerian pension funds can invest up to 5% into private equity, and they don't even do 0.5%. And so it's not by regulation that they worry, it's that they're unfamiliar with the asset class, and they're worried about being able to accurately assess risk. Is that a similar case in Kenya?
No, in Kenya, you can invest, pension funds can invest up to 10%, and the amount itself is negligible that has been invested. I'm sure it's less than 1% on private equity funds. But I think the signaling is important. When now we tighten the regulation and we say you can invest up to 10% in a private equity or venture capital fund regulated by the Capital Markets Authority, it's almost like now it's from the pension funds, you have to go to the CMA and then be able to put money into the fund. I think the signaling part of it, if I was seated somewhere in some global capital looking at it, I would wonder, why do I even have to bother with this? Let the guys who are already there look at it.
I see. So it's more the headache of it than the rules or regulation. Question for Guillaume. One of our audience members has asked, which market segments do you think are most interesting for private debt in Kenya? Like what particular sectors or asset classes?
Yeah, I think when you look at private debt, so you have a number of categories. Basically, you have, I would say, the majority of the private debt funds in Africa, which in a number are quite little, do focus on mezzanine and equity-linked products. So that brings you a bit more towards the equity space than the pure debt sector. So in which case you're looking for returns which are higher, and you're basically happy to take more risks, especially in terms of exposure to the local currencies. When you look at what we think in terms of pure private debt, we think that there's a good opportunity, and it's not only in Kenya, to invest in segments which have a structuring effects on the economies and which are, I would say, less volatile to the environment. So, I mean, typically infrastructure is one thing, logistics, telecoms, power, renewables. But basically, I think that's probably the one thing that has to be maybe adapted is that until now, what we saw in terms of strategies are always quite focused on one sector, especially when you look at the private equity. So you would see funds that are just focusing on infrastructure, the others who are focusing on green, others on agro-industry. Our take is that it makes sense to have a diversified approach and bring an understanding to the market also that you don't need to always identify African risk with high risk, high return. What we've been pushing in the market is that you can absolutely work with medium risk, medium return, and that there is an existing granularity in Africa which needs to be met, and that can really help people meet their requirements, especially international investors who've been having very low yields in the last years.
Yeah, I'm glad you brought that up, because all too often there's this mismatch of expectations of high double digit, like 20-something returns on private equity, say, for example, and then vast disappointment when those returns don't actually materialize. And so the question is, being realistic about returns might actually help stimulate more investment as people are less disappointed and more predictable in terms of their modeling.
No, absolutely. I think the returns that were expected on the private equity, especially those last years, were quite optimistic. At the moment, that shows also that there is I think an overpricing of the African risk, and to be a bit more optimistic of what we've been saying before. I think there is a growing awareness about that, especially in Europe, and maybe COVID counterintuitively might play a positive role in that, because, for instance, for the first time, I had a discussion with a fundraiser in a massive fund in Europe, who was not exposed at all to Africa, and his first reaction post-COVID was to say, well, that's interesting because Africa has been far less impacted than expected. So that's quite an interesting take, and people should look at it. So I think at the moment, this kind of reaction from people who've not been working on the continent is kind of is interesting, because it's quite different from what we're used to have. So it takes time, but I think that now, I think there are reasons to be a bit more optimistic on the perception of the real African risk. and also on the progressive willingness for international players to play a role, and the potential there is for also partnerships with asset managers around Africa.
And digging deeper into different sectors, Edwin, maybe you can speak a little bit about the real estate sector. What are you seeing as a result of COVID in real estate?
Aubrey, it's dead. Because of course everybody wants to be keeping cash. Nobody wants to take long-term obligations. COVID, yes, started as a healthcare crisis. It is now more like more of an economic crisis. There's quite a bit of it that is just pure hysteria and not knowing. So when you have that level of uncertainty, and then lack of credit from the banking sector. So real estate at this particular point, the biggest asset is time and patience and restructuring the debt portfolio. Ourselves, we are restructuring our private debt portfolio. So I think the skill set right now is how do you then navigate through that environment? I mean, even cases where you have bank lines of credit, when the contractor then says, you know, I'm feeling a little bit unsafe and therefore I'm invoking the force majeure, I cannot continue with construction, you know, that really throws you off because then your IRR decays because this is going to take you a long time. So luckily the asset is there and it's visible. It's not as been, it's not taken a beating as much as, let's say, hospitality, but it is really, really tough. Now, that's on the negative side. On the positive side is there will be a world post-COVID and the fundamentals have not changed in terms of rapid urbanization is still going to happen, rapid population growth, under provision in terms of housing. So the fundamentals are there, they are strong, but how do you must survive. And we are taking our worst case scenario is that hopefully by mid-2021, there's some sort of drug or vaccine, but how do you survive from here to then?
Yeah, and this I had a discussion with the president of the African Development Bank, Dr. Adeshina, and he was arguing exactly that this is a detour. The COVID experience is a detour, but the road remains the same. You just got to get back to it. It's young people, it's the urbanization, it's growth of Africa from a just pure consumer base. So I think that's all true, but unfortunately there's going to be incredible cost, human cost, as abject poverty increases, etc. But on the real estate question, I was talking to friends in Nairobi yesterday, and they said that their landlords of their buildings refused to reduce their rents, and so 10 people moved out of the same building. And so there was less of this kind of negotiated viewpoint and mass kind of movement because of intransience on landlord side. So I'm not sure if you as investors are getting involved in such things. Hopefully not. I don't know what kind of headache it's creating.
Yeah, for us, I mean, sharing our own anecdotal examples, we have both developments that are under construction and we have some that are done and we are renting them out. We've gotten requests for rental reduction. Luckily, we have assets in places that have very compelling demographics. Even in a tough time, they're always mini market somewhere. So as an act of goodwill, we've given a 10% discount on rent, but it depends on where you are. But I've not seen what I would call a dramatic drop in rental prices or even a dramatic drop on real estate asset prices. People are looking at it exactly as you said, it's a detour. So why would I do a dramatic? People will do one-off concessions. I'm giving you 3 months concession on rent at half price, but that's it.
Yeah. And so diving a little bit deeper into other sectors, you know, Kenya released its budget last week for July 1 start fiscal year, as did East African players, Uganda, Rwanda, etc. But in the budget, I saw that the infrastructure spend was almost $2 billion. Education and teachers was very high comparatively, and healthcare up over $1 billion as well. So Edwin, how do you see these kind of spends in key sectors, maybe in particular infrastructure and education, helping to address these and create a stronger economy post-COVID?
Yeah, the budget came out where we expected it. I mean, there's not too much room to raise revenue, so it was flat to a little bit negative. If you can't raise revenue, then you can't spend too much. And even in that particular case, they still have to borrow. There's still a deficit. But in terms of the areas that you've talked about, whether it's infrastructure, healthcare, education, those tend to be the typical areas where we spend money. So I didn't see anything surprising in that budget. That's exactly what we expected. We still think the revenue is still ambitious given the ongoing environment. When tourism is down, agriculture is beaten, but we shall wait and see.
And a lot of that revenue was coming in the form of tax breaks, right?
Yeah, a lot of we've also given tax breaks, but having given tax breaks, then the government also is looking at other areas to tax. So it's almost like give on one hand and take it away on the other. I mean, they have to raise revenues.
Yeah, I saw some excise duty debate. So the question of whether you're going to force people to buy local by making everything expensive to send elsewhere.
Yeah, yeah.
And Edwin, do you see the same situation in East Africa, in Uganda, in neighboring countries? Are you investors outside of Kenya at all?
No, for us, we play pretty much in Kenya for now, but I think East Africa is pretty much similar to Kenya in many ways, except that the economies are just a little smaller than Kenya. So I look at it as one homogeneous market. Of course, we are having a little bit of border issues given the COVID environment. Everybody's trying to close their borders. Therefore, trade is going to be impacted. But I think in terms of the fundamentals of this region, population growth, rapid urbanization, lack of housing, the fundamentals are the same for the East African community region. The issue is where the advancement, some areas are more advanced than the other.
Yeah, well, and Kenya is the most advanced in that sense. I mean, Kenya is somewhere around 40% of GDP of the whole region, right? So it's very central in that. Guillaume, there was a question about whether, you know, COVID will cause a bunch of investment to come from the outside into private healthcare. You think there is greater interest in that from European or American investors?
Private healthcare is I think it's a bit of a difficult take because of the exits you can have. So I mean, in terms of private equity, there are some investors who do that, but who are trying to focus more on like healthcare groups with like a growth with a growing opportunity, and which are sometimes cross borders. So on this side, yes. On the debt side, it's probably more going to stay within the realm of the DFIs, because of course it's far more risky profiles than for the others. Especially if you want to remain into decent interest rates, which is important for this project to fly. It's more difficult to manage the structuring of this kind of debt transaction, especially in terms of forex exposure. So if there is no sovereign guarantee behind it, it makes it somehow more difficult. Yeah.
And then we had another question for you on whether whether francophone companies and investors can do well in Kenya. Do you have a lot of examples of that?
No, yes, I think it's they can do well, but just like I don't know, I think President Kenyatta was saying that he was. I mean, Kenya was working a lot with the Chinese, but that they were open to any country who was willing to do a business. So I think it just applies the same way for French companies.
Well, the audience is not surprisingly very excited about tech and the kind of venture space, which I know that neither one of you invest in, but we can talk a little bit about it. There's been a lot of questions about fintech startups and financing. But the issue is, you know, and I do a little in that space. Kenya is one of the hubs of venture investing in African markets. You know, South Africa, Nigeria, and Kenya are the core. And in Kenya, because of M-Pesa and a lot of the mobile money usage that was early and deep, that created the backbone of digital payments, et cetera. So I think that's why there's been such interest, and I expect venture to slow down just like other capital flows, but maybe not as much The venture numbers that have come out for Q2 are pretty on par with those from last year. However, we expect the real impact on venture to hit Q3, Q4. But what I will say is, Edwin, I mean, you living in Nairobi and using mobile money all the time, and I know that they reduced fees during COVID. Are you seeing even greater penetration and use of mobile money and fintech payment platforms that are of interest to you as an investor?
Yeah, there's always this phrase that every crisis has an opportunity, and I think I would imagine it's all over the globe, but in Nairobi you can see it. And I mean, when we say Kenya, in reality, from an investment perspective, a lot of it is just happening within the Nairobi metropolitan area. There is an observable, palpable drive towards fintech, integration, contactless, digital. People are trying very much, if they can, not to go to the grocery store. In terms of delivery from grocery to home, it was not a well accepted norm in Kenya. So people are really, and young entrepreneurs are trying to figure out, what can I digitize? Traffic into banking halls, just like all over the globe, is down 50%. So you definitely have to put more in terms of digital platforms, service experience. So I think there's quite a bit of, even in our own firm, I talked about, yes, we are big in real estate, but we have the regulated public market business. We've invested a lot in making our money market fund very digital, where you can invest, withdraw, real time, use it to pay bills. So there's a big initiative towards digitization all across the sector. So I think one of the things that will come out of this is a very forward-looking technology and digital generation or era, so to speak.
Yeah, I mean, that's the hope, right? And really, you see COVID working to reinforce certain trends and then work against certain other trends. And certainly digitization is one it's reinforcing. Now going to more macro questions from the audience. So one is, what extent do we think quantitative easing will impact Africa's financial systems or Kenya's financial system? And will it change any foreign investor appetite for Africa? And, again, we're seeing money being printed like crazy here in the US, trying to dig out of the crisis, as Edwin mentioned. What will be the impact of that stimulus here on African investment interests? Either one of you, feel free to jump in.
Yeah, you want to go first or I go first?
Please do.
I think while we are connected to the global economy, the amount of trade and the amount of connectivity is still very much limited. And for us here, we've not done any of that quantitative easing. So unless it's going to affect our exchange rate, and the shilling has taken a little bit of a beating, but not a dramatic beating, I don't see it having a big effect in terms of what you can do right here. Except for those who are yield sensitive, then they are going to look to come here to get a little bit of yield, because the economy still remains fundamentally, there is opportunity, there is demand, and I'm talking about past the detour, there is demand, but supply constraints, structural constraints, policy constraint, cost of energy becomes a big issue. And of course, there are the typical challenges we have as like corruption, red tape. So capital will still get a better return here than it would get in the developed markets. But the challenge is in this particular market, how many people in private debt like Guillaume are willing to come here and say, I'm looking for a higher yield at this particular time, even institutionally, just to be able to get those approvals, to get the strategy agreed and come in and say, I'm looking for a higher yield in Africa, it's going to be hard. So I don't see it as fundamentally affecting Africa. I don't see it as fundamentally as affecting Kenya. What I'm watching are the exchange rate, which I think is more driven by export, import, borrowing kind of stuff, more than the quantitative easing.
I kind of agree with that. I think, I mean, to me, the quantitative easing part is more worrying. I would say in the US and in Europe, we had the experience since 2008, and what we saw is that the transmission chains didn't really work as expected. So basically, we faced a mega indebtedness for the sovereign debt side, so which has been increasing very importantly. And while we thought that it would favor consumption, what we saw eventually is that inflation remained almost flat. So the only asset class that really increased was on the stock market. So basically, this transmission that we hope would go on the consumption side and purchasing power didn't really happen. I think in Africa is going to be less exposed to this kind of issue, especially that they don't have this cumulative effect that we're having in Europe, in the US. So I would tend to be less worried about that for Africa rather than for US and Europe. And in terms of investors, yeah, I don't think it will really affect their perception or their market appetite. I think it should maybe play even a different role. It might accelerate this movement towards Africa.
Well, we know that investors, when looking at Africa, have always kind of been stuck in this question of real risks versus misperceived risks. And, you know, I think Edwin hit upon one of the very real risks, which is currency risk. But I'd like to turn to each of you and hear from you what you think the real risks are, how they can be mitigated, and then what you think people are mispricing when it comes to risk of thinking about African markets. So I'll turn first to you, Guillaume.
I think the first thing is that people tend to look at short-term trends. So they're a bit influenced by what you see in the news. So basically, if ever the latest news is some turmoil in some country, then they will instinctively associate like there is turmoil on the whole continent. So which is the first, like, an image perception. The political risk perception, of course, is one of the major points. I think that people need to focus on long-term trends, which was what mentioned by Edwin. We made a presentation in London last year, and we showed the trends in terms of political risk for about 30 years. And of course, there is always varying, but the trend is positive for over 10 years or 15 years. So when you look at that, then you're already starting to change the perception of the market. And I think that one thing which is playing also a role in that is the fact that geopolitical risk is coming back in Europe. So at one stage, international investors thought that there was no geopolitical risk anymore in their business. And now it's coming home. So it's coming back home, which means that there is, again, some sort of sensitiveness to that. So their appreciation of the geopolitical risk now, when it's outside their borders, is becoming increasingly normal because it's coming back home. So that's another point. I think you
hope, but often people have a difference of known risk or unknown risk. So you talk about geopolitical risk in Europe and Brexit and whatnot, but that's like, oh yeah, we know that. Like, it's the unknown risk of Africa that sometimes is worse in their imagination.
Well, I would slightly disagree with that, because before the Brexit, there was not even geopolitical risk. Even the concept, the geopolitical risk concept, have kind of disappeared from the mind. So it was even more alien when you were talking about Africa. So now it's becoming like the African political risk is alien, but it's not alien as a geopolitical risk concept, which used to be the case. So I think that's slightly moving in favor of a perception change.
Well, there certainly needs to be a follow-up call. I know Connell Duffy's on listening. So Connell is our favorite political risk guy out of Chicago. So Connell, I hope you follow up with Guillaume and Edwin on all things political risk. Edwin, what do you think the key, like, real risks are for investors in the region, whether you're sitting there in Nairobi or outside? And what are the ones that are hyped or mispriced?
I think there's certainly a gap between real and perceived risk, because the people with money in the world probably have not traveled, have not experienced. The people who make policy have no good idea, you know. And I think about the most powerful man in the world. If I were to take his perception of Africa versus the reality of Africa, I'm sure it would be like night and day. So, but that's where the opportunity lies, where those who then have a higher perception of risk than the reality of risk will keep away, but those who can assess the risk and deal with it will engage with the risk. Now, of course, Africa is not homogeneous, so it is different places. But looking at Africa generally, the number of coups coups per year have reduced today versus 15 years ago. Currency volatility is much lower than it used to be. Macroeconomic policy is more sensible. If you come back to Kenya, the judicial system still has a lot of issues, but it takes a long time, but you do get justice. 10, 15 years ago, there was no difference between the judiciary and the executive. Today, you see the judiciary and the executive each protecting their own turf. So if you can execute, because I think the key challenges here are ability to execute. Talent is there, raw talent, but you need to make it work for you. And then being able to do this in an ethical and sensible fashion, there is a return to be made. So I think the gap between real and perception is there, but that's really where the opportunity lies. Policy here has become a little bit more predictable.
Yeah, I mean, when you talked about talent and the need to execute and to operate ethically, that screams the need for the right partners, right? And the right investment partners, the right co-investors, the right kind of management on the ground in portfolio companies. And so that's really why Invest Africa exists, to kind of build those networks to come together. And so I really think that that's something that we can all work on together, because from the outside, foreign investors won't always have the local connectivity to be able to assess those risks, right? And that's why they need partners like you, Edwin, and other investors in the space. So I'm cognitive that we have just a few minutes left to wrap up. And I just wanted to kind of leave you both with a few minutes of just saying what your outlook is for East Africa, what's exciting you about the Kenyan market, say by March 2021, which maybe by then means we can all travel and we have a vaccine. So I'll turn first to you, Edwin, and then we'll let Guillaume round it out, and then we'll say goodbye to everyone.
Okay, thanks, Aubrey. Certainly, like every other location, the first thing that everyone is trying to do, not just at the government level, but even at the corporate level, and even at the family level, is how do I stay as safe as possible, and how do we keep the team as safe as possible? So at no particular time will you have an entire team, half of them at home, half of them will be at home, half of them at work, so that if somebody falls ill, at least the entire team is not quarantined. So currently the focusing is cutting costs, keeping the team safe, keeping clients engaged, staying in play the same way we are staying in play here, and engaging through virtual meetings. But as I said, Aubrey, the fundamentals have not changed. It's a detour. I really like that term that you've talked about. It's a detour. So given that it's a detour, is to keep an eye on the highway and an eye on the destination, and just make sure that you can make it through the detour, so that when good times come back, and my own bet based on watching the leading names in infectious diseases, I follow Dr. Fauci a lot. It seems like there will be a solution, and the latest seems to be June 2021. So it's a question of when that comes back. We shall see tourism come back. We shall see agriculture come back. We will actually be in a better place from a technology point of view, because we'll have spent a lot of time investing in digital. So I wouldn't even call it, and going back to the normal, I see a better world post-COVID. And then globally, I think there is a new issue on the table. We are not as isolated as we thought we were. So we have to come up with a global healthcare system. We have to look at the world as really one place, because if an incident in China can now lock us all down in the world, then we realize that, yes, we have these borders, we have these groupings, but in reality, it's one world. So I see a better world, I see a better Kenya, and I see a better business environment post-COVID.
Well, that connectivity and that hope is super contagious. So I really hope that we all can see it that way, and that certainly the digitization effort will reduce some of the inefficiencies that we've seen in the African private sector, African government operations, and in the investor space, because unlocking returns will come from dealing with some of that inefficiency. So hopefully COVID pushes down some of that new technology to address those inefficiencies. So Guillaume, last word for you. What's exciting you in the region, and what are you looking at for the horizon?
Well, definitely, I think what's happening for us is that this crisis has just confirmed our strategy and our vision of the trends that are happening in the region. We believe that Kenya will remain a hub for the region, that there are major projects which are extremely structuring for the economies. That region is showing resilience, which was not expected by most of the investors. So that's a strong positive as well. And so we'll definitely keep moving on this on the region, and especially at a time where we think there will be a number of great opportunities in real economy and real assets, which are a fundamental protection against the volatility we're seeing around here. So yeah.
No, I completely agree. I mean, as much as I am enthusiastic on the tech space, I always say that no economy developed fully without investing in real assets. There's no such thing as just a light asset economy. So we need both, and we need investors like both of you willing to take the risks and to find partners where they be. So I'll turn over to Sandrine so she can close us out.
Thank you so much for everyone that contributed to this conversation and for all of the questions. It's great to see and hear that you all are feeling really optimistic about this market. And so we're excited to continue to track its progress throughout COVID and beyond. Thank you everyone so much for joining. We have our next webinar that will be coming up here in the next couple of weeks. This one will be on the film industry. So moving a little bit more into entertainment. And as we've seen some exciting developments happen in that space, whether it be increasing flow of investors, film investors, increasing participation from companies like Netflix into African markets, we're really excited to feature an industry where we see a lot of development happening and a lot of creativity. So stay tuned for details on that. But again, thank you so much, Aubrey, wonderful job. Guillaume, Edwin, thank you so much for your insight. And we look forward to watching you all grow as well. So thank you so much, everyone, for joining.
Thanks, everyone.
Thank you very much.
Thank you.
Bye.